here's what I'm going to attempt to do today, and the key word is attempt. There's a lot of really good content out there right now explaining what's happening in the mortgage industry. The problem is the content's geared towards loan officers and lenders, and it's about an hour long. And it really needs to be because these challenges are so complex and hard to understand. It's almost impossible to explain them in a few minutes. But that's exactly what we're gonna try to attempt to do today. Guys, we've had this show for a decade. I've been on other shows, podcasts, interviews, written blogs myself, consumed high-level content, watched every video out there right now, and I'm still having a hard time with all this stuff. So if you are as well, you're not alone. So I'm going to oversimplify a really complex problem in a few minutes. To do that, I need to combine several problems into one problem and one analogy. Realtors and lenders and consumers that get this at a high level, don't blow me up in the comment section. I'm simplifying this on purpose and skipping several high-level challenges and concepts on purpose. So that being said, what the hell's going on right now, Ryan? Well, let me set the stage real quick with a real quick explanation on how this begins, and we will quickly get to the problem after that. The borrower goes to a mortgage originator to obtain a mortgage. Once closed, the loan is handled by a servicer, which may or may not be the same company that originated the loan. The borrower submits payments to the servicer. However, the servicer doesn't own the loan, they simply maintain the loan. This means collecting payments and forwarding them to the investor and paying taxes and insurance and answering questions, etc. While they maintain or service the loan, the asset itself is sold to an aggregator or directly to a government agency like Fannie Mae, Freddie Mac, or Ginnie Mae. Got it? We've all experienced this when we bought a home. Now, to the problem. Let me give you the high-level technical explanation and then we'll break it down. Don't tune out because this is going to take me a quick second. Mark-to-market is a term you can Google, but this is what it kind of means. The last 2 weeks, due to accelerated prepayments and the uncertainty of repayment, the value of servicing was slashed in half from 1% to 0.5%. This drastic decrease in value prompted margin calls from many servicers. Additionally, the decreased value of a lender's servicing portfolio reduces the lender's overall net worth. Since the amount a lender can lend is based on a multiple of their net worth, the decrease in value of their servicing portfolio asset, along with the cash paid for margin calls, reduces their capacity to lend. Okay, enough with the high-level stuff, I promise. Now, what does that mean, Ryan? Let me simplify by combining several problems into one in an attempt to explain this. We're gonna take jumbo, we're gonna take FHA, non-QM, VA, and conventional. We're gonna throw them all into the mix, into the analogy, okay? Now, this bundle of paper represents billions of dollars worth of loans. Each piece of paper is a loan attached to a family. For this analogy, we'll say there's several different loans in this bundle. It's not really how it works, but for the sake of the analogy, it does. This one's, say, FHA, and this one's jumbo, and this one's VA, and this one's conventional. Last month, all of this was worth $1 billion. But as the technical explanation said earlier, it's now worth 50% of that. Well, why, Ryan? Well, simply, this group of people decided to refinance with a different company, so they're gone. This group of people lost their job last week. They're in forbearance, not making payments, or even worse, possibly lost their home. So now what used to be worth $1 billion is worth, say, $500 million. Now, let's say I have several of these portfolios of loans. That's what all these reams of paper represent. Well, now this problem just got compounded that much worse. And just like when your house or your 401k loses value, your net worth goes down as well. So does the lender's net worth, and that's the big problem because lender servicers and banks have to lend money to stay in business, and their ability to do so is severely impacted when their net worth drops. They can't overextend themselves. There's certain provisions in place to ensure this. They were put in place after the last Great Recession, and we won't get into that right now. Okay, so back to the analogy. I just lost my you-know-what with these loans. So what do I do now? I mean, what would you guys do if you owned all these loans and just saw your net worth chopped in half? Well, some of you may go, you know what, Ryan, screw this, I'm out. The risk is just too high. I got burned and I don't want to get burned again. Well, some lenders and banks and servicers are doing just that. Peace out. And you can't really blame them for that. Some of you might say, hold on, I'm still in this thing, but it's just too crazy right now. So I'm going to hit the pause button and let all this craziness settle down. Some lenders are doing that as well. Some of you may say, heck, let's keep this thing going. It takes money to make money. I need to lend to stay in business, so let's keep the doors open and do more loans with a few tweaks. These guys aren't stupid. They learn from their past experiences. They'll stay open, but too many people are losing their jobs and there's just too much risk right now. So we'll stay open and continue to do loans, but we want to only take the safe stuff right now. No more risk. We've already had too much risk. We've already lost a big chunk of our net worth. So here's what we'll do until things calm down and get back to normal. We want the safe stuff. No jumbo loans. They're just too risky. Again, guys, I know I'm paraphrasing here. It's being oversimplified for a reason. No bond loans with no skin in the game. They're just too risky as well. We'll just hit the pause button on those bond loans for a month or two. Oh, we'll do FHA, VA, and USDA, but we don't want to take the risk on the high debt to income stuff, and we don't want to take the risk on low credit score borrowers as well. So they limit their exposure and risk by narrowing the type of loans and business they will do. Honestly, this is something we would all probably do as well if we were in their shoes. Heck, there's still a lot of risk with this strategy. They could easily see this option blow up in their face if things continue to get worse. So, rhetorical question, guys, what would you do? Your individual risk thresholds will dictate your response. Fiscal conservatives will probably say, I'm gonna sit this one out. We'll get back into the business after this all blows over. Some riskier folks that like the risk reward may stay open, but with a modified business plan like I just outlined. But hear me on this, guys. Nobody is merely just pushing in all of their chips and saying business as usual. And I get it, and it makes sense to me. All the responses make sense to me. Each bank, lender, and servicer needs to make a decision for themselves and their company. The various responses and business strategies make sense to me. They all do, and I hope this now makes sense to you guys as well. Please tag your friends and families and coworkers in the comment section below. They deserve to hear this and understand it as well. Share on your own pages. And for the umpteenth time, guys, I know we severely oversimplified a really tough problem. You don't need to tell us. We understand mark-to-market, servicing write-downs, margin calls, EPOs, EPDs, hedging, mortgage-backed securities. We get it all. The goal wasn't to impress you all with our knowledge and industry jargon. The goal was to break down something really complex in an easy to understand way, and we hope we did that today for you. Please share, like, and comment. Look for us on social. We're just about everywhere these days, and we'll see you guys next week.